ASML is the crown jewel of the semiconductor equipment industry, the company whose machines are essential to making the most advanced chips the world needs for artificial intelligence, high-performance computing, and next-generation memory. The company's third quarter results underscore that position. Net sales of about 7.5 billion euros, gross margin roughly 51.6%, net income near 2.1 billion euros, and net bookings of roughly 5.4 billion euros, of which about 3.6 billion euros were for extreme ultraviolet lithography systems. Those headline numbers are impressive because they show both strong demand for cutting-edge lithography and continued willingness by leading chip makers to invest in capacity. ASML's backlog and book-to-bill dynamics are what investors watch closely because shipments are lumpy by nature and order cycles can foreshadow future revenue over many quarters. On fundamentals, ASML's durability rests on a set of exceptional characteristics. First, its technology moat is enormous. The extreme ultraviolet, or EUV, platform is enormously complex, requiring specialized optics, laser sources, precision stages, and software. This combination creates very high barriers to entry. No competitor today can produce comparable EUV systems at scale. Second, ASML enjoys strong pricing power and high gross margins because customers have limited substitute options for leading-edge nodes. Third, the company's cash generation ability is significant. Historically, ASML converts a healthy portion of operating profit to free cash flow, funds capital expenditure, and returns capital to shareholders while still investing in research and development. Fourth, its customer base is concentrated among the world's top foundries and integrated device manufacturers, which gives ASML visibility into multi-year capacity plans, especially around AI and advanced memory. Digging deeper into the income statement and balance sheet dynamics, the third quarter margin profile is instructive. A gross margin in the low 50% area reflects a combination of high-value EUV shipments, software and service revenue, and operating leverage. Operating expenses remain meaningful because ASML invests heavily in research and development to stay ahead in high-NA EUV and related system improvements, but the incremental margin contribution from higher EUV content is powerful. Net income of about 2.1 billion euros reflects both strong underlying profitability and the impact of timing in shipments and services. From a cash flow standpoint, ASML typically shows robust operating cash flow. And with a relatively conservative balance sheet and manageable leverage, it has the flexibility to invest in capacity, expand service operations, and execute share repurchases if management chooses. Order intake and backlog deserve extra attention because ASML's cycle timing matters. Net bookings of about 5.4 billion euros in the quarter, with 3.6 billion euros attributable to EUV systems, signal ongoing capital spending for advanced nodes at major customers. That said, management commentary about potential softness in China, demand for the next year injects caution into the outlook. Regional demand shifts can materially affect the timing and mix of shipments. The company's guidance for the fourth quarter, which implied an uptick to roughly 9.2 to 9.8 billion euros in net sales, shows confidence in near-term execution. But the lumpy nature of system deliveries means investors should expect volatility in quarter-to-quarter results, even as the multi-year secular trend remains favorable. From a valuation and return perspective, ASML often trades at a premium to the broader market and to many industrial peers, reflecting its quasi-monopolistic position in advanced lithography and the high profitability of its product franchise. When you assess valuation, consider normalized earnings and cash flows over a multi-year horizon rather than a single quarter. Discounted cash flow models that assume continued strength in AI, memory, and logic demand, plus moderate penetration of high-NA across leading foundries, produce attractive fair value estimates relative to many other capital equipment names. Conversely, the risk to valuation comes from an adverse shift in capital expenditure by the hyperscalers and foundries, or if geopolitical restrictions materially limit ASML's ability to serve key markets. Turning from fundamentals to a practical technical read, the stock's price action over the past several months has been dominated by two themes. Momentum driven by strong bookings and occasional cautionary pullbacks tied to the China commentary. On a typical chart, the most important moving averages to watch are the 50-day and 200-day averages. A persistent advance supported by rising volume with the 50-day above the 200-day suggests an intermediate bullish trend. Conversely, heavy negative divergence in momentum indicators like relative strength index or moving average convergence divergence, especially on a volume spike, can signal near-term exhaustion. Traders will look for consolidation patterns after big booking or earning announcements. Healthy consolidation that holds above prior breakout levels is constructive. Failure to hold established support levels suggests a deeper correction. Support and resistance should be thought of in ranges rather than exact lines because ASML's stock tends to gap on news. Look for areas where price previously stalled and where volume was dense. Those zones are evidence of buyer or seller interest. Buy-on strength is a common approach with ASML. If the stock retests a breakout on lighter volume and shows renewed accumulation, that can be a lower risk entry. Risk management is paramount. Given the asset's high correlation to semiconductor capex cycles, use position sizing and stop rules tied to both technical invalidation points and fundamental triggers such as a sharp deterioration in EUV bookings or a major customer delay. A deeper technical nuance is relative strength versus semiconductor capital equipment, peer indices, and versus major chip makers. If ASML outperforms the group on a relative basis while the group is advancing, that is a positive structural signal. If ASML lags its peers while the sector advances, it is a warning sign that company-specific risks, such as regional demand concerns, are being priced in. On the competitive landscape, ASML's core EUV technology remains unmatched, but the company does face challenges in other parts of the stack, including the development of high numerical aperture systems and ensuring customer yields and uptime. Competitors in niche subcomponents and in immersion lithography persist, but none match ASML's scale and integrated offering for the most advanced node transitions. The company's ability to maintain production ramp discipline, manage long lead times for complex optical components, and keep its customer support and service network tightly integrated will determine how smoothly the industry continues to adopt newer nodes. Now let's examine ASML in a structured SWOT discussion, rendered as narrative so it is easy to read aloud. Strengths include technological leadership in EUV, a deep and long-dated backlog, attractive margins, and strong free cash flow generation. These create pricing power, customer stickiness, and the ability to finance long-term R&D. Weaknesses are the company's exposure to a cyclical capital equipment market, the complexity and long lead times of its products, which create execution and supply chain risk, and a revenue concentration by customer and region that can amplify any localized slowdown. Opportunities are numerous. The AI compute boom drives increased lithography intensity per wafer, advanced packaging and heterogeneous integration create new equipment needs, and government incentives for domestic semiconductor manufacturing in multiple regions could accelerate orders for ASML systems. Threats include geopolitical restrictions that could limit sales to certain markets, potential disruptions in key suppliers of optical components or lasers, and the inherent cyclicality in chip capex that can quickly swing from boom to bust. Investors should also consider the optionality embedded in ASML's service and software businesses. As more systems are deployed, recurring service revenue, spare parts, and software upgrades become a larger share of total revenue and often exhibit higher margins and more predictable cash flow. This recurring stream can act as a partial hedge against the lumpiness of system shipments and supports a higher valuation multiple if management can grow it steadily. In evaluating the balance sheet and capital allocation, ASML typically maintains a conservative financial position with strong operating cash flow. That allows the company to self-fund a large portion of R&D and capital investments while also returning capital to shareholders. Watch for any sizable shifts in capital allocation policy, accelerated buybacks or major acquisition moves, as these can change the investment thesis. Management's communications around reinvestment into high-NA development are important. The High NA program is the next technological frontier, but it is capital and time intensive, so successful milestones and demonstration of manufacturability will be key catalysts. From a risk management perspective, technical buyers should plan for the possibility of increased volatility around booking announcements and regional guidance updates. Fundamental buyers should size positions relative to portfolio risk tolerance and be prepared for drawdowns that often accompany equipment cycles. It is sensible to monitor lead indicators such as foundry capex guidance from major customers, DRAM vendor spending plans, and government subsidy announcements in major semiconductor producing regions. Putting the pieces together, ASML's long-term investment case is rooted in unavoidable secular demand for advanced lithography driven by artificial intelligence, cloud compute, high bandwidth memory, and advanced logic. Its monopoly-like position in EUV and its roadmap into High NA give it structural advantages that few firms possess. At the same time, short and medium-term returns will fluctuate with booking cycles, regionally sensitive demand, and the cadence of new node adoption. For investors who prioritize secular exposure to AI and are comfortable with hardware cycle risk, ASML represents a compelling core holding. For traders seeking shorter horizons, the stock offers meaningful swing trade opportunity around news events, but requires disciplined risk controls. On balance, and assuming the industry continues to invest in leading-edge nodes at the current multi-year trajectory, ASML is recommendable as a buy for long-term oriented investors who accept the cyclicality inherent in semiconductor equipment. The upside is tied to continued EUV adoption, High NA progress, and broadening of the customer base into memory and packaging domains. The primary cautions are geopolitical constraints, potential supply bottlenecks, and the timing risk tied to China demand. Monitor quarterly bookings, the book-to-bill ratio, High NA technical milestones, and margin progression in services versus systems as your primary checks on the investment thesis.